Hi everyone, welcome back. In the last video, I talked about how I built a counter using Poem Share Builder plan regularly over the last 7 years. If you have missed out, you may click on the link provided to find out more. That's right, this counter that I built regularly over the last 7 years was known as Capitaland Mall Trust and now known as Capitaland Integrated Commercial. Capitaland Mall Trust was first listed in Singapore Stock Exchange in July 2002, then merging with Capitaland Commercial Trust and known as Capitaland Integrated Commercial Trust in November 2020. Capitaland Integrated Commercial Trust is the first and largest real estate investment trust listed in Singapore Stock Exchange with market capitalization of 13.5 billion as of December 2021. Back in 2012, when I first started out investing, the list of counters provided in the Poem Share Builder plan was quite limited. My objective for that time was to build up the highest frequency for dividends reinvestment to complement the dollar cost average strategy in accumulating more shares. STI ETF was out of question as the dividends payout was semi-annual. So I narrowed down my pool of selection within the STI's constituent. That's where I came upon Real Estate Investment Trust, which distribute quarterly dividends. And out of the REIT list, I shortlisted Capitaland Mall Trust, reason being its strategic retail location around Singapore is visible enough as a retail development. And of course, Singaporeans like to eat and shop, right? Moving forward, what is the strategy of Capitaland Integrated Commercial Trust? Before we move on, do like this video, and once again, this video does not constitute to any form of financial advice. Please do your due diligence because the market is not a playground, it's a slaughterhouse. During the ongoing pandemic in 2020, Capitaland Commercial Trust merged with Capitaland Mall Trust in November 2020 in view of better managing assets. The current portfolio for year 2021 financial results consists of 96% assets based in Singapore and the rest overseas. The three segments of retail, office, and integrated development are evenly distributed. There is one clear indication of integrated development on trend as we can see the newly completed Capital Spring in 2021, which comprises retail, offices, as well as service residentials. With the easing of COVID restrictions, the revenue income from retail segment has also increased compared to 2020 to 2021. There is a noticeable revenue and income which more than doubled in both office and integrated development segment, which suggests more people are returning back to work in the office. You could see how CICT diversified its streams of revenue with the retail segment making up near 60%, followed by the office segment 30%, and 10% in hospitality and overseas offices. The reconstitution of portfolio expansion into Australia offers a diversified income base and growth. Coming to Q1 2022, we can see the divestment of both George Street and JCube are being channeled to the expansion into Australia and Sky. Again, in the property value by geographical and asset type in Q1 2022 update, dependency on retail segment has decreased while further expanding to the office segment and additional expansion into Australia. In addition, no single tenant will control more than 6% of Capitaland Integrated Commercial Trust total rental income. With some government-backed companies in the house, you could say the flow is wun jiabi. However, challenges rising ahead are the interest rate and inflation. With the rising interest rate environment, the cost of borrowings for business will increase. The fixed interest rate borrowings will also decrease in proportion to that. Hence, an important element in REIT to take note is the gearing ratio, which are financially leveraged with capital equity or debt. As we focus on the retail segment, we see that the occupancy and retention are still above 90%. The increase in sales per square feet in rental space also means higher costs for the tenant, and this in turn shows an increase in rental reversion. The lease may end up available longer than expected, where it affects the shopper's traffic. It's common when a company faces capital distress to raise shares through rights issues as debt to shareholders or buyers at a discounted price. So the agenda of the company such as a REIT is important in the sense that the issue is to enhance asset or clearing of borrowings. A strong REIT can enhance an asset through Asset Enhancement Initiative, AEI, without requiring funding from shareholders. On the other hand, the office performance overview improved as we see more returns of the office community with easing of COVID restrictions. Rent reversion also increases as demand starts to pick up, with leasing inquiries from top 3 business sectors like IT, media and telecommunications, financial services providers such as banks and insurance companies, and energy and commodities. Capitaland Integrated Commercial Trust focus in 2022 is to create value through diversification of portfolio, seeking growth opportunities, and at the same time, delivering sustainable value through AEI and potential acquisitions. Do like and subscribe to my channel if you find this video informative. And I will see you. Adios.